bond portfolio management. Like any other investment, like equities, bonds are all subject to risks. Please mute the video. We have seen in portfolio management the various types of risk that equities have. We have seen diversifiable, non-diversifiable risk, all that we have seen. The same way, bonds are also subject to risks. These risks are classified into two different categories. This topic has been given as an assignment, though you have, all of you have submitted the assignment, but it's very important topic that we need to discuss, especially for examination point of view, which is asked in section C or section B questions. The bond risks are broadly classified into two broad categories. One is controllable and uncontrollable risk. First one, we call it uncontrollable risk, which the company cannot diversify this particular risk. The company cannot control this particular risk. That we call it non-diversifiable risk. The first one, what we have is interest rate risk. We call it market risk. The interest rate very depends on bond price. We have seen interest, the yield and bond price are inversely related. Higher the bond, higher the yield, the lower the price. Lower the yield, higher the price. So both are inverse related. So a rise in interest rate decreases the bond price, whereas as a fall in interest rate increases the market price of the bond. So this is nothing but what we have seen earlier. Yield and price are inversely related. The interest rate risk is also known as market risk. So it's a function of maturity period of the bond and its coupon rate. So we have seen how to calculate the price of the bond, the present value of interest payment and the present value of principal payment. So the larger the maturity period, then that will be higher the sensitivity of price to changes in interest rate. The larger the interest payment, the lower the sensitivity and the lower the maturity period. So price and yield are inverse related. So it is broadly known as the market risk. So that the company cannot have any control over this particular risk. All of you are getting it? All of you are with me?
Yes, sir.
Yes, sir.
Yeah. Sanjay, understanding?
Yes, sir.
Okay. So interest rate risk is nothing but market risk. So higher the interest rate, lower the price. Lower interest rate, higher the price. The next one, what we have is the inflation risk, which the company cannot have control over this particular inflation, that we call it rise in price. So, Anamika, can you please come down? So it is here we should have the term called nominal interest rate. Nominal interest rate means a coupon interest rate, that we call it a nominal interest rate. And the real interest rate that we need to have. The real interest rate means after deducting the inflation rate from the nominal interest rate, we call it real interest rate. So for example, the nominal interest rate, the coupon interest rate is 12%. The inflation is say 6%. The real interest rate will be 6%, 12% minus 6%. So the changes in price certainly affect the interest rate. So that will affect the bond price. So that the company cannot have any control over this. This means inflation risk is greater for long-term bonds. I mean, the higher the maturity period, the inflation risk is very higher. The rise in inflation decreases the bond price, and the decrease in inflation enhances the market price. So the prices are increasing, the bond price will come down. In a period of highly volatile bonds, highly fluctuating interest rates, the company should, the investors should prefer floating rate bonds. for shorter maturity bonds because the inflation has got a greater impact on these prices. All of you get it? All of you are getting it?
Yes, sir.
Inflation
Yes,
risk.
sir.
Inflation risk is nothing but the rise in price. So when there's a rise in price, the interest rate will fall. Subsequently, the price will fall. Got it?
Yes, sir.
All of you are getting it?
Yes, sir.
Yes, sir.
Okay. Then we call it real interest rate risk. The same thing, what we have seen earlier. We are taking it as a separate point. Real interest rate, as we have seen earlier, nominal interest rate minus inflation rate. So to calculate the real interest rate, the nominal interest rate is taken first. The real interest rate is equal to nominal interest rate minus the actual or expected inflation rate. So the real interest rate gives the lender investor an idea of the real rate that they receive after factoring the inflation. The inflation rate is highly unpredictable. So we cannot predict the inflation rate. See, for example, the real interest rate is falls from 6% to 4%. So in this case, the company has borrowed a funds at 6% interest rate, 6% real interest rate, that will suffer because the company can get only 4% in its assets. So, but the company has to pay 6% on its debt. So in this scenario, the company has to accommodate the risk called the real interest rate risk. So the changes in real interest rate is a source of risk that borrowers and lenders, borrowers and investors have to face. So inflation risk and real interest rate risk are closely related. Getting it? All of you are
Yes,
real
sir.
interest
Yes,
rate.
sir. Yes, sir.
Okay. Then we have liquidity risk. Liquidity risk. The company, unlike stocks, bonds do not have a liquid secondary market. We cannot sell bonds as we sell equities secondary market. So except some of the popular government of India securities which are traded actively, most debt instruments do not seem to have very liquid market, unlike equity market. So the market for debt is mainly as an over-counter market, because which is over-counter, what we mean here is an organized market, and much of the activity seem to occur only the primary market, new issue market. So they do not have a secondary market what we have as we have for equity market. So given the poor liquidity in the debt market, investors face difficulty in trading debt instruments, particularly when the quantity is very large. So they may have to accept the discount over the quoted price while selling and pay premium while buying. So the liquidity is a major concern for the debt market, the debt instrument, or we call it bond market. So liquidity, what we mean is we cannot sell the bond when we wish to sell, as we have for equity market. Got it?
Yes, sir.
Alan, Charlie, are you getting it?
Yes, sir.
Okay. Then we have reinvestment risk. It is after receiving the interest from the company, we can reinvest in some other instrument. So when the interest rate falls, the future, the interest payments may have to be reinvested at a lower interest rate. So that is called the reinvestment risk. So when the interest rate is falling, and we'll have to invest in the instrument which offer the lower interest. So that risk is called reinvestment risk. The reinvestment risk is greater for bonds with a longer maturity, and a bond with have higher interest payment. So when we have longer maturity period, you will receive interest for a longer period. So at that time, there is the reinvestment risk subject into it. Then we have a foreign exchange risk. It's only for foreign bonds. So when we have a foreign bonds, when we have a bonds from other countries or banks which are situated in foreign countries, so we receive in the foreign currencies. So those foreign currencies are subject to foreign currency fluctuations. So the bond has payments that are denominated in foreign currency. The rupee cash flows are uncertain. The risk that changes in foreign currency will depreciate in relation to Indian rupee is referred as what? Foreign exchange risk. So because whenever we receive interest payment or principal payment in dollars or some other foreign currency, when this foreign currency is fluctuating, the risk that is arising from that particular instrument is called foreign exchange risk. Okay. All of you understanding?
Yes, sir.
Okay.
Yes, sir.
So these are all
Yes,
the interest rate risk, the inflation risk, liquidity risk, reinvestment risk, foreign exchange risk, and then real interest rate risk. These risks are not controllable. No company can control these particular risks. And we have a controllable risk, or we call it a diversifiable risk, that is default risk. The default risk, the risk that the borrower may not pay interest or principal on time. So the company could not pay the interest amount and the principal amount on time. So other things being equal, bonds which carry high default risk may be sold at very lower price. So the change in that perceived default risk of a bond will have immediate impact on its market price. So the best example what we can quote here is the S Bank, which is into a bigger crisis now. State Bank of India is going to be bought by this particular S Bank. So I have quoted the S Bank example here. So S Bank had additional. Please mute the video. Please mute the video. Please mute. Yes Bank had additional tier 1 bonds, 81 bonds we call it. So these bonds are issued by this S Bank, which has got the value of 10,800 crore. Now the bond holders of these S Bank could not get the interest payment and principal payment. This is called default risk. The S Bank could not pay the interest payment to these 81 bond holders. So these 81, that is additional tier 1 bonds. So these additional tier 1 bonds are annual coupon bonds which have no fixed maturity. They are called perpetual bonds. There is no maturity period. So the bondholders carry very huge amount of risk. And these holders of these bonds can get their investment back by selling the bonds secondary market. Now, these bondholders cannot sell secondary market because the bank is under the huge crisis now. So that's called default risk. All of you understood? Default risk, all of you understood?
Yes, sir.
Okay. Then another control risk that we have is call risk. At any time, the company can call back their bonds. So at that time, the bondholders have a huge amount of risk. A bond may have a call provision that gives the issuer, the company, the option to redeem the bonds before the